Market update. I'm your host for this evening, Lee Seiler, also known as the Stock Doctor. Thanks for joining. And as always, please, if you don't watch this live, if you don't finish it and you have to go do something, watch it tomorrow because it'll be on Facebook. You can share it with your friends. There's going to be a lot of great information because tonight I'll be giving you your fiscal therapy. I just came up with this, actually. Fiscal therapy. And you're going to need it after today because what happened in the market. But how does that make you feel? Okay. Anyway, I don't really pay attention to who's on the Facebook Live things. I really don't because I know people start coming on, they come off, all that kind of stuff. But I did hear a song in the intro, and I see Sean, my good friend, Sean McMahon from a terrific band in town, My Generation. Radio Gaga. I don't know if you guys. I know you did something with the Queen Live Aid show. You do some songs off of that. I didn't know if that was one of them because I haven't seen it. But anyway, hope everybody's doing well. Look, the market's not doing well. And last Wednesday, and I'm giving you numbers from the week previously because I want to make sure everybody's clear. Today is Wednesday, May 13th at 7 p.m. By the way, as you notice, I'm usually punctual. I like to be punctual because I think it's important. Why penalize other people, make them wait for being punctual? Okay. So, I talked about the last few weeks, for example, last Wednesday, the markets were down, the major average is down about 3%. Now, from the close today, for last Wednesday, the S&P 500 down 2%, the Dow Jones down 2.6%, the NASDAQ is down 1.3%. But I got to tell you, what happened today, it started out not too bad. I'm going to show you a couple things. Started out not too bad. I mean, we were down a little bit, maybe up a little bit. Apple was up, and that's really a benchmark. I mean, Apple's been a great benchmark, which, by the way, if you have questions, we do have some questions in the house, but if you have questions, you can email Nikki at stockdr.com. You can call the office. Somebody's here. Nikki's here to answer the phone calls. But the markets were in bad shape today. So let's go over those numbers. The Dow Jones Industrial Average down 500. That's right, a five handle, folks, a five handle. 516 points at 23,247. The NASDAQ Composite was down 139, which is about 1.5%. And the NASDAQ Composite was in positive territory for the year. Not sure if it still is after today, but it was. Down 139 points at 8863. The Dow Jones Industrial, which of course is not the most important one, we want to look at the S&P. So I gave you the Dow numbers. The S&P numbers were down 1.75%, 50 points at 2820. And again, what I was saying over the last several weeks that we love this rally. The rally felt good, okay? Because what we felt on March 23rd was not good. It felt awful. The rally was nice. The rally is 35% off of the March 23rd low for the S&P 500. 35%. Over 700 points on the S&P 500. And I've been saying that we are due, we are in need, and we are likely going to have this pullback. And we are seeing it. 2 weeks in a row now, we're down. The average is down. And today was a really volatile day. And remember I said I need that W. We need that, not necessarily retest. I think we saw the lows. March 23rd is the lows. We've seen it. But you have to give a retest. You can't go up 35% straight, really, without having any substantial pullback. So the bottom line is, of the 700 and change points we're up in the S&P 500, we can get back a third to a half of that with no problem, and that's likely to happen. So let's take a look at the charts. I'll give you that. Let's see here. Hold on. This is a chart of the S&P 500. All right. And remember, I said that we're looking for a bottoming process. The market, it takes time to bottom. This is all part of the process. As I said, this March 23rd, that's the low. I think that's in place. I believe that number is going to hold. I think the low March 23rd is going to hold. And I always said, I thought, hey, we need a W. We need that test. We haven't seen it. But now what we're seeing is, to me, a more ominous pattern. What you're seeing here is a double top. Okay? It's a double top. So the market rallies basically and really uptrends. And rule number one in technical analysis is that trends persist. What does a trend mean? You want to see an uptrend, a series of higher highs and higher lows. So you want to see going up, pulling back, hitting another high, pulling back, hitting another high, which what we saw here pretty much. It rallied, pulled back, hit a new high, pulled back, hit a new high, pulled back. But then this was not a new high. And what's more, it is getting ready to break the bottom of that double top. Remember I talked about a W base? Well, guess what? This is like an M top. It's the polar opposite of a W base. And when it breaks that line there, then you have support that has been broken. And I believe that the next test could be somewhere around these levels, and that is around 25.80, probably 26 and change. Probably I'd say this breakout, which is more likely. And that's 26.37, and we closed today at 28.20. So I think we have about 180 points downside on the S&P 500. And here's why. Yes, we rallied. But what drives stock prices? Earnings. And corporate earnings are shit. Well, they should be. Business just didn't slow. Business shut, which, by the way, speaking of business, I want to give a shout out to Fuel Barbecue. These guys continue through the whole crisis, continue to do business, had carry out, now they're open, 25% capacity. And I want to, Woodford Reserve, you see this is what I'm drinking tonight for my physical therapy. And I'd like to thank Fuel Barbecue for the Woodford Reserve. Thank you very much. I know Stevie Q, you probably appreciate that I'm not drinking Crown, drinking something else. So anyway, the market needs to pull back. We're going to see that. Jay Powell came out, the chairman of the Federal Reserve, which I think has done a really great job. Look, nowhere in the handbook teaches, okay, what do we do when there's a pandemic? Okay, they don't come around that often. They have happened, though. Pandemics happen all the time. But it never happens where business stops. I say all the time. It's been coming on. Pandemics has been around since for eons. Since the beginning of time, we've had pandemics. Spanish flu, Asian flu, bird flu, N1N1, H1N1, AIDS, et cetera, okay? Pandemic's been around since the beginning of time. The actually cutting business off, shutting it off, zero business, has never happened. So what concerns me also is that with the markets rallying how they are, or were, it's really been limited to a few stocks. And this is just what has happened. That the market has gravitated towards the biggest and the best. That's okay. I mean, 42% of the NASDAQ is 5 stocks. 42% of the NASDAQ 100, which has been in positive territory. Name the 5 stocks, okay? Microsoft, Apple, Amazon, Facebook, and Google. Alphabet, okay, but Google. Those are the 5. Those 5 represent 42% of the NASDAQ 100. Crazy stuff. So we're pulling back. Earnings season's over. I also said that. Look, we're pretty much, for the most part, I mean, Cisco came out with earnings today. They were better than expected. Of course, Cisco built the plumbing of the internet. And that's CSCO on the NASDAQ. It's they beat expectation on the revenue and on the earnings side. And they also guided higher going forward. So that's positive. Now, keep in mind, Cisco, we're using a lot of internet right now. And they sell routers and again the plumbing, but their big thing now is WebEx. And although WebEx is a really small part of their business, there's a lot of people using WebEx these days. And I think the reason the top tech companies are working right now is because, well, you're doing work from home. You got to make sure all your Microsoft products are up and running and upgraded. Well, you probably need another laptop if you're going to start working from home. So buy another Apple or an iPad. You're shipping your stuff. Amazon, okay? Well, what else are you going to do for entertainment besides watch TV, drink? You go on Facebook, Instagram, okay, the top 4, and then Google. You're searching things. Their cloud business is kicking ass. So the NASDAQ represents, 42% represented by those 5 stocks. The S&P 500, those 5 stocks represent about 20% of the S&P 500. So Jay Powell comes out today, and he says, look, we may need more. He says, we're not out of the woods, basically. I'm surmising. I'm paraphrasing. He thinks there's more that will need to be done. And they have been aggressive, and it's been large. So what's happening here, well, here's my concern. And I don't know the answers. I have no idea what the answers are. Who's paying for this shit? I don't know. Again, that's rhetorical. I'm asking it. I don't know the answer, nor do I expect you to know it. But somebody's going to have to pay the piper. And we had a guest on our podcast last week, Pete Winters of John Hancock, and we were talking to him about it, and he doesn't know. Nobody knows what's going to happen. I mean, is our dollar going to be basically worthless? I don't know. I have no idea. So Jay Powell, which I think has done a great job, he says we're going to need more help. Yes, there's no doubt. Looks like there are people getting their money, stimulus checks, all that's going out. There's still unemployment check problems. But, think about this. I don't remember the government, and maybe somebody can remember this, but I don't remember the government giving out unemployment money. I remember the states doing that. You're $275 a week, but now you can get up to $875 a week with the government assistance on that. So the question is, and here's how long the market will be in this kind of volatility and or question marks, is because we need to find out how the economy is going to open. We're getting an idea. Things are starting to open, albeit at a small pace. That's okay. It's controlled. More importantly, hopefully, it's safe. We don't know. If the government or if business, after it gets up and running again, we get that second wave and they panic and they shut us down again, all bets are off. I have no idea. Nobody knows. So I just think that owning some things that are protective in your portfolio are important. For example, we've been using these buffered ETFs, and a lot of these buffered ETFs are doing extremely well. First of all, they're not as volatile as the market. They'll mirror the S&P 500, but they protect you on the downside. So they're liquid, you can sell them, but if you hold them for a year, some have a 10% buffer, meaning they'll eat the first 10% of risk. So if the market goes down 20, guess what? You're down 10. Now you're limited on your upside to 12, 13, 14, whatever the cap is. And there's some that say, we're going to protect you 25%. And I'm not going to get into what they are and the logistics of them. I'm saying is they're out there. And that's things that people should use, especially if you're either close to retirement or in retirement. Let's add some of these to the portfolio, because these buffered ETFs, I think, are gold. Because you can have market type returns, but not the market downside. And that's basically you're the house. So I like that a lot. I want to talk about a few things, because people keep asking me what we believe will happen after the market. We've had a bad quarter, obviously. First quarter is bad. Second quarter, economically, GDP is likely to be bad. Not sure yet how the market's going to perform the second quarter. We had a great month of April. We've had a crappy so far month of May. But the bottom line is, markets do extremely well after a Q1 decline. And I'm going to show you this real quick. This is a chart. Let me see if I can expand it a little bit. Okay. Oh, yeah, I can. All right. Let me see here. Okay. Take my word for it. This is 1933. Okay? 1933, we had a 15% decline in the first quarter, and then followed by the rest of the year up 70%. 1935 and 11%, followed by 59. As you can see, the market usually, S&P 500 performs well. Let's go recent time. In 2001, first quarter down 12%, rest of the year down 1%. Hey, I'll take that. 2009, the first quarter down 12%, the rest of the year up 40%. Now, I'm seeing some conservative estimates for the S&P 500. I'm seeing in a guy I respect, and I think he's sharp and he's right most of the time, Brian Westbury of First Trust. He's targeting a 3,100 S&P 500 by year's end, and do the math. The S&P is at 2820, so he's thinking 10% from here. I mean, that's okay. It's reasonable. That's a 10% would normally be a pretty good year. So I think that would be okay if that happened. And we're likely going to see something like that. I'm going to try and show you a couple other things too. And where is it? Okay, I'm not going to get into that right now. But I do want to talk about, which I am going to get into. I want to talk about the yield curve. I've been doing these Facebook Live videos for quite a while. I mean, they've evolved. I'm now in front of my bar. I'm having a drink. It's kind of relaxing. It's Wednesday evening, what else are you going to do in quarantine? Well, not anymore. But a yield curve, an inverted yield curve, and think about this. When you go out and let's say if you were going to loan money, think about it this way, because it's a bond is a loan. If somebody said, all right, I'm going to borrow money off you and pay you back in 3 months, how much are you going to charge me? Okay, I'm going to charge you 5%. Whatever, I'm just throwing a number out there. They say, okay, he pays you back. He goes, all right, now I want to borrow the money for 10 years. How much are you going to charge me? Oh, well, 10 years, I'm going to charge you 8%. You would do that, right? Because in 10 years, a lot can happen. There's a lot of risk, a lot more risk in 10 years than it would be 3 months. So that's why you would charge less. That's why bonds, the yield or the money they pay you in interest is typically less the shorter term the bond is versus the longer term. So back last year, the yield curve got inverted, and the yield curve is an indicator for recession. And I saw an interview, and it's a guy, he's a sharp guy, Wall Street guy, who is a contributor to CNBC on a daily basis, Josh Brown. You may see him. He's a younger guy, but he's a sharp guy. I saw him at the ETF conference in South Florida, and he brought a guy named Campbell Harvey. Campbell Harvey is a Duke finance professor, not bad pedigree. He invented, or basically he made prominent, the inverted yield curve indicator. And basically it turned negative last year, and what he does is that it has to turn negative and stay there till the end of the quarter, which it did Q2 of 2019. So in June 30th, the yield curve was negative. So that is now, because it was 7 for 7. Remember, we don't have recessions very often, but it is 7 for 7 accurate with no false readings. There's been 0 false readings. So last year, Q2 closes. Guess what? The 3-month Treasury has a higher yield, meaning if you bought the 3-month Treasury, you got paid more than you would for the 10-year. Because they were saying, wow, there's some risk here short term. So the yields get inverted. And when that happens, it's a sign of recession. Now, within 12 months. So now we're in a recession. Absolutely 8 for 8. I want to show you this because this is really interesting. Let's take a look here. Okay. Let's see if I can expand this one. All right. So this is back in the early 80s. You had an inversion. The highlighted is the recession. But let's go here where you can actually see it. This is 1990, all right? The Asian contagion. You had an inversion of the yield curve. That's below the bold line. We had a recession within 12 months. You move on. Yields get below in 2000. Okay? Recession. Of course, he doesn't have the reasons why. He clearly didn't know COVID-19 was going to be around the corner. That's not about that. He didn't know. He said in his interview, whether we had COVID-19 or not, we may have still had a recession. So maybe not this quick and this drastic. So 2000, same thing happened. Then 2007 and 8, you had the recession. You had the inversion recession. And here we go. So that's really interesting. And that basically is a sure shot indicator within 12 months. And again, what's interesting is he had no idea of COVID-19. 0 idea of COVID-19. Okay, hold on a second. We have a question in the house. Okay, hold on. Okay, first of all, Jane from Winter Springs is asking a buffered ETF, what are they? What you mean, what are buffered ETFs? Okay, let me explain to you. First of all, let me take a step back. An ETF is an exchange traded fund, so it's a basket of securities. It's like a mutual fund, but it trades on an intraday on the exchange. So an ETF trades intraday with this buffering protection. What they do is that they buy options to protect the overall position. They're buying the S&P 500 and they're buying options. All right. So the S&P 500 is what you're basing it on. So the options in 1 year will mature or expire. So what happens in that time frame? If you are down, it will pay you a certain amount depending on which options you use. So I'll give you an example. There are several different versions of buffered ETFs, but I think I mentioned one. They're going to say, okay, you're going to own the S&P 500. If you hold it for the year, you don't have to because it's liquid. It trades like a ticker symbol. If you hold it for the year, you have that protection. So if I bought it in February, and February of 20, and then February 21, the S&P is down 10%. In one version of that, I am flat. They will give me back that 10%. They're protecting me 10%. If it's down 15, I'm only down 5. If it's down 20, I'm down 10. All right, so they're giving me 10%. Now, for that, you got to give something up. They're limiting your upside to, I think it's 12, 13% or so, roughly. I'm sure which issue that is, but they're going to be around 13, 14%. So what that means is if the S&P goes up 20, they get 6%. You're going to be left with 14. But you're okay with that? Who's not okay with making 14%? And it's not your entire portfolio. It's part of your portfolio being protected. There's another version of a buffered ETF. And what it does is it has a 25% buffer. What that means is you, as the investor, you eat the first 5% downside. So the market goes down 5%, you're down 5%. Market goes down 30%, you're down 5%. Market goes down 20%, you're down 5%. Market goes up 10, they cap you at 8. So the 8 market cap on those more protected issues, it's more conservative. It's more of a bond type issue, the way I look at it. And it's really, it's a phenomenal thing to do. So I hope that, Jane, I hope that answers your question. But buffered ETFs, there are a few companies out there that actually issue them. We use a couple different ways or a couple different issuers. First Trust has one, Innovator has one, some really interesting products out there. And I like having those. It's almost like a part of a bond portfolio. You're not getting the interest part of it, but you're getting conservative growth. And that's basically you want to look at in this climate. You want to look at conservative growth. So listen, we're going to answer more questions, all right? And we do it throughout the week. People call in, and I appreciate that. By the way, you see the email, see the phone number. You can call the office for an appointment. Bottom line is, folks, we're here to help you. And we know that it's tough to manage a portfolio right now in this climate. We get it. It's something that we've been doing. I've been doing it for 32 years. And guess what? I'm going to be doing it for a lot more. I get a lot of questions. People asking me, excuse me, I was just looking for charts. People asking me, how long am I going to be doing this for? Well, first of all, I could do this from anywhere. I choose to come to the office every day, and I enjoy it still. But at some point, I'll be doing it from somewhere on the water, hopefully. All right, Nick, if there's anything else, I'm not sure if we have anything else. I'm looking. Let me know because we're gonna start wrapping things up. Okay, so here's what we got to look at now. The month of May. Remember the old adage: sell in May and stay away. It's 50-50. I'm not sure that it's going to work this time, but the bottom line is, it is again of how the economy opens back up. All right. I want you all also to listen to our podcast. We have a podcast out there, the Stock Doctor's Prescription, and okay, that's good. The Stock Doctor's Prescription. It's on. We upload it on Fridays. It'll be recorded sometime tomorrow, Friday morning. It'll be out there. You can hear it on Apple iPod or Apple Podcasts. You can hear it on Spotify, among many, many others. But I really appreciate everybody joining us. I want to try and keep it short tonight. You guys are awesome. Share this. Please share it. Also, next week, we'll be back on Wednesday night. So join me here. And again, StockDR.com. That's StockDR.com. I hope you enjoyed your fiscal therapy. I am Lee Seiler, the Stock Doctor. Have a great evening.